Hello, this is Andrew Schwartz, and I'd like to thank you for taking time out of your busy schedule to check out this presentation on retirement plan basics for practice owners. I hope you will find this information to be helpful to you as a practicing doctor. Once again, my name is Andrew Schwartz. I'm partners with my brother Rick Schwartz in the CPA firm of Schwartz & Schwartz, based in a suburb north of Boston. Our practice focuses on the accounting, tax, and basic financial planning issues affecting healthcare professionals in their practices. Let's start by discussing some of the benefits of setting up and maintaining a retirement plan for your practice. The first benefit is that contributions you make into the retirement plan are generally tax deductible, and then those contributions grow tax deferred. Remember, contributing to a retirement plan is one of the best tax shelters available to people during their working years. Here are a few questions I get all the time. Why bother contributing to a retirement plan? Especially since the stock market until recently hasn't performed all that well. When you contribute to a retirement plan, the taxes you save provide you with an immediate return on your investment. Let's assume you're in the 28% federal tax bracket and live in a state with a 5% tax rate. So each additional dollar of income you earn is taxed at 33%. In this scenario, you would earn an instant 49.25% return on your investment by contributing to a retirement plan. That's because it only costs you $670 in after-tax money for every $1,000 that is now invested. You've already earned a whopping $330 on the $670 you invested. Yes, you will owe income taxes on the money withdrawn from those accounts down the road, but you get to invest the government's money over all those years that the money stays invested. And you get to keep the investment earnings on the government's money. Trust me, investing the tax savings over time really adds up. The compounded growth on the tax savings can easily add up to tens of thousands of dollars or more. For example, $100,000 invested and earning an average of 8% per year over 25 years will grow to be worth $685,000 within a tax-deferred account. What happens if you pay taxes each year at a 33% rate? Since your compounded return falls from 8% to 5.35%, this $100,000 investment will grow to just $370,000 over 25 years, assuming all the income and growth within the account is fully taxed each year. That's how powerful tax-deferred compounding can be. There are additional benefits of a retirement plan. For starters, money in most retirement plans is protected from your creditors. That's great news for anyone in a profession where getting sued is not completely out of the question. Please check with a lawyer to find out which types of retirement accounts are protected based on the rules of your state. Plus, contributing to a retirement plan is one of the best ways to build up a nest egg to fund your retirement. If you own your own practice, it's up to you and you alone to make sure you have enough money set aside to fully fund a comfortable retirement. And the earlier you start building up your nest egg, the better chance you give yourself to reach your retirement savings goal. Looking for additional benefits of maintaining a retirement plan for your practice? Offering a retirement plan might be a way to help you attract and retain staff. It is also one way to reward staff for loyalty and longevity at your practice. Practice owners generally agree that having a good staff is a key ingredient to having a successful practice. Let's take a look at the most common types of retirement plans offered by practice owners these days. The first group of plans is fully funded just by the practice owners. These include SEP IRAs, KEOs, and profit-sharing plans. The second group is funded largely with employee salary deferrals, and these include simple IRAs, 401ks, and safe harbor 401ks. The basic plan option if you want to fully fund your employee's retirement is a SEP IRA. With a SEP, the percentage of your salary that you will put away for your retirement is equal to the percentage of salary you will need to contribute into each eligible employee's SEP account. The maximum contribution is 25% of W-2 wages, or 20% of net self-employment income, up to $51,000 in 2013. Here's an example of contributing to a SEP where your salary is $255,000 and your eligible staff members earn a total of $200,000. Later in the presentation, we'll discuss who is an eligible employee. In this example, you'll contribute 20% of your salary, or $51,000, into your SEP account. To do so, you need to put away 20% of your staff's salaries, or $40,000, into their SEP accounts. You as a practice owner would only keep 56% of the money contributed that year. The more sophisticated version of the plans where only the employer can contribute is a KEO plan or profit sharing plan. Unlike a SEP, these plans allow for vesting schedules, which means that if an employee leaves before staying with the practice for a certain number of years, a portion of the money allocated to that employee reverts to the plan. The most common type vesting schedule is to vest 20% of the account each year over 5 years. So if the employee leaves after 3 years, the employee takes 60% of their retirement account and the remaining 40% reverts to the plan. These types of retirement plans also provide options to allocate a higher percentage of the money contributed to the practice owners. You'd want to meet with a retirement plan specialist who can help you best design a plan to factor in your age, income, and other demographics to maximize the percentage of the annual contribution allocated to you. The second group of plans shifts much of the burden for saving for retirement onto the shoulders of each employee. The basic option is a simple IRA. For 2013, the maximum salary deferral is $12,000, increased to $14,500 for anyone 50 or older by December 31st. The practice is then required to offer a 3% matching contribution for people who contribute during the year, or a 2% non-match for all eligible employees. We'll get to who is an eligible employee soon. Let's take a look at the maximum simple contribution, assuming your salary is $255,000 and your eligible staff members earn a total of $200,000 and all contribute at least 3% of their salary to the plan. In this example, you'll contribute $12,000 through salary deferrals and will receive a matching contribution of $7,650. The salary deferrals for the staff doesn't matter since that money is coming out of their pay, but we do need to include the matching contributions of $6,000. In this case, you put away $19,650 for yourself and are able to keep 76.6% of all the money contributed out of your pocket. The more sophisticated version for these type plans is a Safe Harbor 401k. For 2013, you and each eligible staff member can put away a salary deferral of up to $17,500, increased to $23,000 if 50 or older by December 31st. Under a Safe Harbor plan, the practice is required to offer a 4% matching contribution or a 3% non-matching contribution. And unlike a simple, the 401k allows for additional discretionary profit-sharing plan contributions. These contributions get allocated like the profit-sharing plan contributions discussed earlier and also include vesting schedules. You will rely on your retirement plan consultants, also known as third-party administrators or TPAs, to show you how your profit-sharing plan contributions would be divided among you and your staff members based on the plan design. Let's take a look at an example of the maximum Safe Harbor 401k contribution, assuming no additional profit-sharing plan contributions. We'll once again assume that your salary is $255,000 and the eligible staff will earn a combined $200,000 and will all contribute enough into the 401k plan to get the maximum matching contribution. In this example, you'll contribute $17,500 through salary deferrals and will receive a matching contribution of $10,200. Once again, the salary deferrals for the staff don't matter since that money comes out of their pay, but we do need to include the matching contributions of $8,000. In this case, you put away $27,700 for yourself and are able to keep 77.6% of all the money contributed out of your pocket. You also have the option to put away additional money for you and the staff as a profit-sharing plan contribution. So let's take a minute to review the 4 plans we've addressed so far. While a SEP and KEO do not provide for employee contributions, the Simple and 401k rely on them as a primary source of funding. The first 2 plans also don't offer matching contributions, while the second 2 plans have mandatory matching or non-matching contributions, and all the plans except for the simple allow for discretionary contributions to be made each year. So who do you need to include in your practice-sponsored retirement plan? For a SEP, it's any employee who worked for you at least 3 years and has earned more than $550 in each of those years. That person would be eligible for contributions starting in year 4. For a simple, you need to include an employee who earned $5,000 during either of the prior 2 years and who is expected to earn $5,000 this year. And for all other plans, an employee becomes eligible on the next entry date after working 12 consecutive months and 1,000 hours in a calendar year. Most plans have 2 entry dates each year, January 1st and July 1st. A person who begins working between January 1st and June 30th wouldn't be eligible until the following July 1st. Someone who starts working the second half of the year would wait until the following January 1st to be able to participate. When a plan has a vesting schedule, some of the money contributed for employees who stop working for your practice might revert to the plan upon separation of service. Most plans will offer either cliff vesting, which means an employee becomes 100% vested after completing 3 years of service, or they choose the option that vests at 20% per year over 5 years. SEPs and Simples can't include vesting schedules, so if you make contributions for an employee who quits the next day, that employee will take all the money in their account with them. KEOs and profit-sharing plans generally include vesting schedules, and while the 4% match or 3% non-match is fully vested under a Safe Harbor 401k plan, any additional profit-sharing plan contributions will need to be vested. How expensive is it to maintain these plans? The cost is minimal for SEPs and Simples, while maintaining a KEO, profit-sharing plan, or Safe Harbor 401k plan can run $1,500 to $3,000 or more per year. And while SEPs and Simples don't need to complete and submit a Form 5500 to the IRS each year, the other plans do. And even though there is no tax due with these information returns, there is a failure to file penalty of $25 per day that the form is late, which adds up to real money pretty quick. One way to make these retirement plans more cost effective is to employ your spouse and have your spouse take advantage of the plan. This strategy makes the most sense with Simples and 401ks, provided your spouse isn't already maxing out his or her salary deferrals at another employer. And please keep in mind that your spouse only needs to earn slightly more than the deferral max, since Social Security taxes need to be taken out from the gross pay before money can be sent to the Simple or 401k. Let's look at a few examples where you earn $255,000, your spouse earns $25,000, and you have 4 employees each earning on average of $50,000 who all qualify for the plan. With a separate KEO, you'd put away 20% of everyone's pay, which means you'd put away $51,000 for yourself, $5,000 for your spouse, and $40,000 for the staff. So to put away $56,000 for your family, it costs $40,000 in contributions for the staff, which means you keep 58.3%. With the Safe Harbor 401k plan, you put away $17,500 of salary deferrals for yourself, plus receive a $10,200 match from the practice. Your spouse also puts away $17,500 of salary deferrals and receives a $1,000 match, and for your staff, the maximum match would be $8,000, which equals their $200,000 in salaries times 4%. With the Safe Harbor 401k, you put away $46,200 for your family, and it only costs you $8,000 in matching contributions plus 401k admin fees. In this example, you keep 85.2% of the money put away. One other retirement plan worth noting is a defined benefit plan. One popular version of these plans is known as the cash balance plan. With all the plans we looked at so far, the contribution determines the benefit. With a defined benefit plan, the annual contribution is based on money needed to fund a future retirement benefit. In other words, the benefit defines the contribution. These plans routinely allow for owner contributions in excess of $100,000 per year. However, they are much more expensive to implement and maintain and might require higher contributions for the staff as well. Defined benefit plans are great plans if the circumstances are right. This is generally when you are older than your staff, starting to get close to retirement age, can afford to make $100,000 plus contributions into a retirement plan each year and need to quickly build up a retirement nest egg. Please speak with a retirement plan specialist if you feel that defined benefit plan might make sense for your practice. If you have any questions or comments about this presentation or have ideas for other presentations, please let us know. You can call my office at 800-471-0045, or you can email me at andrew@schwartzaccountants.com. Thank you for taking time to check out this presentation today, and I hope you found this information helpful and insightful. Please also visit our nationally recognized website, mdtaxes.com. You can go to the site to check out our monthly tax newsletters. You can post questions on our bulletin board, which will get answered by the MD Taxes CPAs. And you can sign up to receive our newsletter by email each month. Thanks again. Hope you enjoyed the presentation.